Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevenson. Sit up, take some notice. Today, I've managed to get the attention of Andy Schectman. He is the founder and CEO of Miles Franklin. If you don't know who they are, you should. Not only are they a bullion dealer over there in the US, but they look at their clients and give them not advice, but they look at their overall portfolio, and it's more strategy as well as not just selling the bullion. But what Andy doesn't know about what's going on in the macro economy, why he thinks that gold is wealth, not an investment. And I want to talk about the debt ceiling, lots of other things, because it is coming up to the end of May and that debt ceiling in the US is looming. Andy Schectman, great to see you. Thanks so much for joining me today.
Hi, Carrie. It's great to see you too. It's been about 10 months since we were together down here in Florida, and I know I'll see you again in person in a few months, but it's good to get a little bit of a sneak peek here on Zoom, and it's great to be back here with you.
Let's do a just quick shout out for that thing that you mentioned, which is Rick Rule's Investment Symposium. Ladies and gentlemen, if you're not going, go and do yourselves a favor and come over. It is one of the best events over there in Florida, which is where Andy's speaking to me from. But as you will find so much information. I know that you're speaking there, aren't you, Andy?
I wouldn't miss it. In fact, ever since Rick has been doing this conference, originally it was in Vancouver.
Yeah.
It's the one conference, the one day of the year that I circle, or the one weekend that I circle. The best speakers. It's an honor to be there, and it makes it a lot easier now, being able to drive there instead of fly to Vancouver. I shouldn't say that for you having to fly from Australia, but nonetheless, really worth going. It's the best and the brightest, and it's a conference that I'm really proud to be part of.
Yeah. So, ladies and gentlemen, if you'd like to come along, it is the 23rd to the 27th of July in Boca Raton, Florida. Right, Andy, enough about Rick. Let's talk about what is going on over there. As I speak to you towards the end of May, as I just said, that US debt ceiling, I mean, it's monopoly money these days. Are they going to fix the problem, or are they going to kick the can down the road?
No, I don't believe they're going to fix the problem. Certainly, it's not a problem that is fixable. I mean, if you want to be honest, we talk about a $31 trillion debt approaching $32 trillion, but that ignores the elephant in the room that no one seems to talk about. And that is, well, what about Medicare? And what about Medicaid? And how about the $77 trillion shortfall in Social Security that Reuters just told us a few weeks ago will be completely insolvent in 10 years or less, 2033. What about government military pensions? These numbers exceed 130, $140 trillion. And so you add that to the $31 trillion debt, you're approaching $200 trillion. And a trillion seconds ago was 31,688 years ago, Carrie. My mentor, Richard Russell, he was so far ahead of his time. 20 years ago, he was saying the Fed has no choice but to inflate or die. And when you talk about this mountain of debt, how do you ever pay it off? The majority of which was accumulated over the last 15 years at the lowest interest rates in human history. Mm-hmm. And if you would just simply ignore all of the 31, almost $32 trillion debt, and just focus on Medicare, Medicaid, Social Security, and government military pensions, that's 4 times the debt that it just conveniently off balance sheet. And when you talk about will the debt ceiling, will they raise it? Ultimately, they'll have to, or they'll abolish it. But I don't believe there's going to be a resolution before June 1st, if I had to guess. Why? 2 reasons. One, look at the rate of return on the 1-month treasury at over 6%. That's just not right. That's not normal. But even more than that, the biggest reason is the credit default swap market on the treasury market. Now, credit default swaps are things that banks will buy. It's like an insurance policy that banks will buy to provide insurance against other banks, or against in this case, the treasury market, or any investment. These big banks will buy insurance. And if you look at the premium on the credit default swap, of the treasury market, it's gone through the roof. It hasn't been this high since 2008. These are the most sophisticated traders on the planet who are more or less telling you that there will be what's called a technical default, where neither side budges and the doors close and the lights go off, and then we sit and go back and forth in hyperspeed. We got to open up, got to open. Look, this doesn't affect their ability to pay the military. They still have the printing press. But in terms of there being a technical default, I think the probability of it is tremendous. I think there will not be a resolution, and I'm very concerned for the ramifications of that, the knee-jerk ramifications of a society here in the U.S. of people who are very reactionary, have very much recency bias, normalcy bias. They forget that we just had a catastrophe with the banking system a few weeks ago, and that was papered over. Everything's okay now. So they've gone back to business as usual. But I think this is a very big mistake this time around. I think that there are a lot of things that we'll get into here that could lead to really some very, very frightening times in the banks, the banking sector, and the ramifications of what this truly means to the bigger picture with not only the U.S. debt, but the de-dollarization that's going on. Don't think our foreign creditors are not watching this, and they're not very pleased with what they're seeing.
No.
We're kind of acting like a spoiled grandkid who has wasted away his great-grandfather's fortune and now is asking for another loan to continue partying. So I don't know. I guess we'll have to see, but I'm not convinced that we'll see a resolution before we run out of money.
You said something just at the start there, which was inflate or die. Aren't we, or aren't you, US, aren't you inflating? I mean, they're saying 7% inflation, but the reality is it's a lot higher than that. Can't they inflate this debt away?
Well, sure, that's what they're trying to do. But in living in a bubble, sure. But when you pride yourself as being the world reserve currency, at what point does the rest of the world say, well, no, I'm not going to sell you my oil from Saudi Arabia.
Mm-hmm.
I'm not going to sell you our party favors, China. At what point does the rest of the world say, no, we don't want dollars that are being destroyed and inflated away? But more importantly, rising inflation has a byproduct, and that byproduct are rising interest rates. And they go hand in hand. You can't have 10, 12, 15% inflation with 5% interest rates. Yeah. Your currency becomes trash, becomes Weimar Republic. And so as inflation continues to go higher, and that's why they have been very opaque in the way that they allow you to see it. There used to be something called M3, which is the broadest measure of the money supply. They don't print that anymore, citing it as archaic and too costly. They continue to change the metrics by which they gauge inflation. As you mentioned, you're speaking of shadow stats or something like that, where John Williams of Shadow Stats calculates inflation the way that it used to be calculated prior to 1980. And he will tell you that inflation is closer to 10% than it is to 7%. But even still, when you look at a 10-year treasury rate now paying 3.5% versus 7% inflation, that is a real negative return of 2.5% per year compounding. And of course, the bigger distortion being 6% return on a 1-month treasury versus 3.5% return on a 10-year. This inverted yield curve is basically saying that the big traders believe you will see interest rates go down and you will see them reaccommodate. You will see them quantitatively ease. They have no choice, Carrie, because again, this debt that we are talking about ignores the other liabilities, most of which are due to the American public. And so either you inflate or you default. How else do you pay off this mountain of debt? Remember, 1 trillion seconds ago was 31,688 years ago. These are numbers that have gotten too big to ever be paid off with anything other than the printing press, because we're not going to produce our way out of this through an increase in productivity, as we've outsourced almost all of our manufacturing. We don't produce much of anything anymore. So it's inflate or it's a default. And sadly to say, I don't see much of another way out of the entire picture of nearly 200 trillion in debt.
I mean, you're starting to talk, Andy, it becomes the funny money. And I want to get into the BRICS area in a moment. But before I do, mentioning about do we need the banks anymore? There's a lot of talk about central bank digital currency. These numbers are getting out of control, like literally, as you just talked about, the trillions and trillions that are getting bigger and bigger and bigger, and they're going to have to work it out. Is there going to be a complete reset where they can get this under control in a whole new way?
Well, I've been talking about a reset for 2 or 3 years, and I've been talking about it as it pertains to de-dollarization, of losing the Federal Reserve status in the rest of the world, the BRICS in particular, this growing chorus of countries that are moving together against the Western hegemony. That is where I was focused. But when you take a look at what's going on here domestically, you have to start to wonder. I mean, there are three people that I'd like to mention as I talk about, do we need the banks anymore? But one thing before I do is one person in particular, the head of the IMF, Kristalina Georgieva, where she came out and said she has blamed the problems with the U.S. banks on complacency. And she says that the fact that the rapid pace of bank runs, she says, were fueled by savers' ability to move money quickly with the quick click of a mouse, and that requires more regulatory action and more scrutiny. In other words, she's saying your ability to move money needs to be regulated and curtailed. Very frightening when this is from the head of the IMF. But there are two people that I want to call your attention to, and I'd like you to I'm going to show you the dots, and then you connect the dots, and you can, and everyone else out there who's listening to this can think for themselves what it means. There are two names that kind of answer that question in and of themselves to me. And one of them, her name is Lael Brainerd, and the other is Jared Bernstein. Lael Brainerd, I thought, was going to be the head of the Federal Reserve last year when Chairman Powell was up for reappointment. After all, he was appointed by Trump. I didn't think Biden would reappoint him, but he did. Lael Brainerd was his main challenger. She had come from the Treasury Department. Then she ran for the head of the Fed. She finished second, I guess you could say. They inserted her as vice chair at the Fed, number 2. And her whole thesis in reading it when she was running for the Fed was a modern monetary theory, abolishing all of the banks, including the commercial banks. Her theory was that monetary policy is not effective when it is reliant upon the commercial banks to lend money. That's how money is created. And so her theory is you get rid of all of the banks, and if you need inflation, it comes directly to your iPhone from the central bank. And even though she said it was controversial, if you needed to slow things down, you could actually take money from the people. And this is her theory. Now, okay, so what does that have to do with anything? She was at the Treasury, number 2 at the Fed. She just left, and she is heading up an economic advisory committee at the White House. And, what better way to pen everyone first into a handful of commercial banks than to blow up some of the regional banks? And after Silicon Valley Bank failed and Signature Bank failed, there was an inquiry done by the House, and the representative from Oklahoma asked Janet Yellen, Madam Secretary, he said, you just bailed out these 2 banks, and we were under the impression that after the 2008 financial crisis, bailouts were made illegal. She said, well, the taxpayer won't bear the burden of this. Yeah, right. Well, she said, okay, cool. Well, then let me ask you a question. If a regional bank fails in Oklahoma, will my constituents be made whole? And she said, no. Nope. What do you mean, he says? Well, she said it has to be a uber majority decision from the FOMC, which is the Federal Reserve, the FDIC, myself, and the president, to deem whether or not those banks are systemically important enough to be bailed out. In other words, that lit a fuse under the regional banks. And then if you look at what's going on right now with the overnight reverse repo market, the Fed controls, they're paying about 5.25%. Well, that's where all the money market funds that the commercial banks sell are going. All of it is going into the overnight reverse repo market, paying over 5% with daily liquidity, versus being in a regional bank that isn't too big to fail like the commercial banks. that the best you can get is about 4.5% in a 1-year CD. You're locked in for a year. And if the bank fails, you're an unsecured general creditor of the bank, versus moving all your money into a money market or into treasuries. If it's a money market held in a commercial bank who puts it in the overnight repo market, guaranteed by the Fed, earning more than you can get in a CD with daily liquidity. The banks are dead. They're dead. And we can talk about the fact that they have no reserves, and they're filled with toxic assets that are all valued at 40 or 50% of what they were when they bought them. Fine. If they wanted this to stop, they could say no more money is going into the reverse repo market that comes from a money market. Now, let me just get back to where I was going. What did Lael Brainerd want to do? She wants to get rid of all the banks. So you blow up some regional banks. What did Janet Yellen just tell us? If the debt ceiling impasse isn't fixed, dozens of banks will fail immediately. If you see more banks start to fail and the Fed not step in to bail them out, or JP Morgan, and bang, 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 money is lost. There's unsecured general creditors. People are freaking out. They're all going to go flying into Citi, JP, Morgan Stanley, Wells Fargo, et cetera, and into the safety of the money markets. Okay, so this is where you have to suspend your imagination a little bit. You look at the derivative position of a company like JP Morgan with over 50 trillion in derivatives. You let one of those banks blow up, it brings down the whole system. They're all so systemically tied together. We can't print all this money to bail out all of these players, but have no fear, because who's here? Lael Brainerd and her new CBDC. This is her whole theory. We'll make all of you whole. Sign on the dotted line. You'll get a new central bank digital currency. The whole system blows up. You get a great reset. But wait, how about the other guy I mentioned, Jared Bernstein? In 2014, Jared Bernstein wrote a report entitled King Dollar No More, I believe it was called. In it, he advocates that the United States government must actively take steps to immediately relinquish its world reserve status because of the distortions it creates, trade imbalances, market bubbles, all sorts of reasons that he had. Okay, well, what does that have to do with anything? Well, Biden just appointed him his top economic advisor. So you got one guy that wants to get rid of the dollar as the world reserve currency. Think about how we just weaponized the dollar against Russia a year ago. Think of all of this in the big picture. You got another advisor saying, let's get rid of all the banks. Put these two together, look at all of the things that we are doing, look at the instability that we are creating, and bang, you blow up one of those commercial banks after everyone has rushed into them, the whole thing goes down. Here's your chance to reset your new central bank digital currency, relinquishment of the world reserve status. Both of these advisors who are advising the president get what they are asking for. Now, I'm not saying that's going to happen, but you have to wonder why these two people are running advisory committees at the White House.
Yeah, join the dots. But Andy, one of the things, because I'm sitting talking to you from Australia, we have a global audience, but we also have a majority of people here in Australia. And I know that you're over there in the US and you very much look at the US markets, but do you think if this reset does happen, what are the ramifications globally?
So I think what you would see at that point, I mean, there's a meeting with, I don't know how many, 50 or 60 countries that are meeting in St. Petersburg in just a month or so. A lot of talk is about them issuing a gold-backed settlement currency. You have the BRICS nations who, they've talked about issuing a commodity-backed currency now for over a year, call it a reserve currency. You have the Shanghai Cooperation Organization, who has talked about issuing a gold-backed Eurasian continent settlement currency. Common denominator in all of this is that Saudi Arabia, which makes the dollar the world reserve currency because of our protection of them, is now being protected by Russia, has just recently applied to the Shanghai Cooperation Organization, which is the largest regional military and financial organization in the world. They have formally applied to BRICS, as we've mentioned. They are on the Belt Road Initiative along with every other OPEC country. And they told the folks in Davos a month ago that they're open to taking other currencies for oil. The alliances that are being made, sidestepping the dollar, are accelerating tremendously. There's 150 countries on the Belt Road Initiative. And when you put the Belt Road, the BRICS, the Eurasian Economic Union, and the Shanghai Cooperation Organization together, Shanghai Cooperation Organization alone is about 60% of human population. You're talking close to 85 to 90% of human population that I believe has a desire to break free from the Western hegemony. So much so that China has been able to broker a peace deal between Sunni and Shiite, between Iran and Saudi Arabia, to where they're building embassies in each other's countries after centuries of hatred, where they brokered the first ever railway between Iran and Iraq and Syria, countries that have hated each other. But what? My enemy's enemy is my friend. So what do I think will happen globally? I believe that will begin the end of the dollar as the world reserve currency. I think you will see rampant de-dollarization. And when the world dumps dollars, because after all, every country on the planet, including Australia, has had to stockpile US dollars to buy oil since 1974. That was the deal we made with Saudi Arabia. But Saudi Arabia just struck the same deal in terms of military protection, not only with Russia, which they did in September of 2021, but in joining the BRICS and the Shanghai Cooperation Organization. You're in bed now with China, and you are in bed with a lot of big military powers. Put it all together, I think you will see a rampant de-dollarization. And if Saudi Arabia at that moment, a country who we've told we're going green, a country who's watching the dollars that they receive for their oil be inflated away, to your point earlier, why can't we just inflate it? Why am I selling you your oil, our oil, for $1? You're inflating and you're going green. And how about the treasuries we own? As rates rise, they're being eviscerated. You guys suck. We're going to go with the BRICS nations and the Shanghai Cooperation Organization and the Belt Road Initiative and all of these people, including every OPEC country on the Belt Road. We're all not going green. And I have just as big of a military presence behind me as you have provided for me for the last 50 years. And for that, I thank you. But we're not going to take dollars anymore for oil. When that happens, bang, every country on the planet dumps dollars. And it becomes a tsunami of inflation. It will bankrupt, or it will overwhelm the issuer, that being the US. You'll see massive inflation. You'll see everything collapse here. Inversely correlated to a rise in interest rates. Because as that inflation hits our shores, inflation goes to the moon. It will affect everybody. But I'll tell you something, there are rumors, and I know they're just unsubstantiated rumors right now, that Australia is inclined to consider joining the BRICS, just like Mexico just did formally join the BRICS. And when you see a country like Australia rumored to be interested in breaking free of the G7, moving to the BRICS, it's a very frightening thing. Look at France. Macron just signed a 51-point deal, 51-point treaty with China, ranging from 5G technology to military engagement.
Wow.
Came out and said, we will not back the US in their efforts to stop China from reunifying China and Taiwan. We can't even do anything here with the Ukraine. What makes us think we should get involved with China? He said, we won't do it. You're beginning to see our allies break free. And when it gets really bad like that, as far as I'm concerned, it's every man and woman for themselves. And to see Australia side with the BRICS wouldn't be something that would surprise me. So what happens? I think it gets very bad and very isolated for the West, and any countries that move to a new system that will be backed by commodities, I think will be in the right position in terms of countries moving in the right direction.
But Andy, just recently we had the Australian Prime Minister, the UK Prime Minister, and of course your President Joe Biden, all coming together with a kumbaya moment with the submarine deal, and we are all in this together. That doesn't sound to me like a country like Australia moving towards BRICS. It looked to me more like we were very much siding with the US. Or do you think things have changed since then? Or is Australia just going, we're going to flip-flop?
Yeah, look, France was right there with us in 2022 when we sanctioned Russia. France was right there all along with us in all of these decisions that have been made, and now they're moving away from us. I think at some point self-preservation becomes a whole hell of a lot more important. And this is one of these deals where, look, the US still has enough influence and power where you don't want to show your hand, and maybe you don't want to agitate the situation until you have no choice but to make a decision. So, look, they are still a Western ally, but I am saying you're beginning to see those allies slowly walk out of the room and do the Irish goodbye. Where they go? Look at Mexico,
Yeah.
and look at Turkey. They're our ally. They've formally applied to BRICS, and they're a country that's bought more gold than anyone in the world for the past year and a half. Because why? The BRICS nations told us they will issue a commodity-backed currency. What was gold revalued as by the Bank of International Settlements in 2019, the only other tier one reserve?
That's
So
right.
you can see the pieces that are being put into place. I do believe if the chips were down, I think a lot of the world that we would consider our allies will have a hard time sticking with a ship that is sinking. And more importantly, if the dollar loses its world reserve status, because it is the petro reserve status, it is the backing of the Saudi kingdom that has made everyone had to own dollars for 50 years. It's created synthetic demand. If you no longer need to hold dollars any longer to buy oil, and you could argue put together these other countries are as imposing as anything that we could ever do militarily and have a bigger GDP. In fact, it has been estimated that the BRICS nations will outpace the West in terms of contribution to global GDP this year for the first time ever. They are growing, and so are their numbers and their cohesion. So I think this is a trend in motion, one that you must keep an eye on. To me, it's the most important thing in the world.
But the majority of people aren't paying attention, and the majority of people are, I guess, a little bit asleep. And as I speak to you right now, Andy, I'm seeing the death of the middle class, a smaller percentage that are wealthy, and a long tail of people that live paycheck to paycheck. Do you see that creating social unrest as we go forward? Because I've been saying for a while now, it smells a bit rank at the moment, and it's very imbalanced. Will we ever get back to being a more balanced society, or do you think we have to go through this turmoil to get out the other side?
I think we're in big trouble. I think the majority of the people in this country, I think it's over 60%, are living paycheck to paycheck. You're seeing massive bankruptcies going on. There have been 70 major bankruptcies in retail businesses here in the U.S. In the last 4 months. The big companies like Bed Bath and Beyond and other big corporations that are disappearing. And yeah, I think that you have seen the evisceration of the middle class. Look at credit card usage is at all-time highs, and with inflation roaring, and ironically, food and energy and housing not calculated in the Bureau of Labor Statistics measurement of the CPI. Cost of food is enough where people are having to use their credit cards for daily expenditures. And so when you talk about debt, yeah, the American public not only can't get out of the way of what they don't see coming, but they're loaded up on debt. Their credit card usage is at all-time highs. And I think that this will be a deal where there will be civil unrest. There will be problems, and you can see it already. There is in the big cities. I mean, look at, I don't know how much media coverage you get, but in places like San Francisco and Chicago, it's chaos. And you're seeing all these corporations and these companies leave these cities that were once the crown jewels of the United States. I mean, San Francisco, you're seeing like Whole Foods leave because they're not safe there. And the police aren't protecting they're not coming in and arresting these people for common theft. And they're coming in and stealing and threatening. And, it's a very big problem because there's divisiveness already, whether it's black, white, or red, or blue, or vaccine or no vaccine. There's such divisiveness in this country. And then you look at open borders where 6 or 7 million people have come in illegally. You look at this fentanyl crisis. There's so much stuff going on. You look at a country where $5 billion to build a border wall to keep people from coming in illegally and poisoning our children. The number one cause of death for teenagers in the United States right now is fentanyl poisoning. And so that's too much, but $140 billion to the Ukraine. Well, that's okay. We have $40-50 billion left in the treasury before we are out of money unless they raise the debt ceiling. In order to raise the debt ceiling last time, Janet Yellen said, well, we need to take extraordinary measures. You know what those were? They were to borrow money from the Postal Service's retirement fund, the Disabled Veterans Retirement Fund, and the Civil Servant Retirement Fund. Is that the same type of borrowing, I wonder, as the US government just publishing their 2022 balance sheet and said that Social Security is $77 trillion filled with IOUs? Trillion seconds ago was 31,688 years ago. Ain't ever getting paid back. And so these are problems. And that's why when I say it's inflate or die, if you raise rates high enough to combat inflation, the whole house of cards crashes globally. So you'll do what every other politician has ever done since the beginning of time, and that is to choose inflation over austerity. This is why you're seeing the central banks buy more gold in the last 18 months than any time in history. This is why you're seeing the London Metals Exchange.
Wait, Andy, wait. You said this is why we're seeing the central banks buy more gold than they have done in history. Expand on that for me.
In the last 18 months, the amount of gold that was purchased by the world central banks is greater than at any time in history, ever, never before. You look at all of the countries that are joining the BRICS nations, they are massively accumulating gold, all of them. You look at the exchanges, like, for example, the COMEX vault. The COMEX vault has lost, it's down to 29 million ounces in the registered category. It's lost 130 million ounces of silver in the last roughly year and a half. You're looking at the fact that right now the registered category are the bars that back the contracts that back the bars in circulation, or the bars that are for sale on the COMEX that the contracts are written off of. The commercial banks right now are short 9,000 contracts, which is 45 million ounces. There's only 29 million ounces in the COMEX, in the registered category. If everyone who has the other side of that says, I want delivery, there's 15 million ounces of silver where's it coming from? The amount of gold and silver that are being bled down from the world's exchanges, in fact, just this week, 144,256 kilograms of silver left the Shanghai Gold Exchange. That's the largest single daily outflow in the 10 years since silver was listed on the Shanghai Gold Exchange.
Give me that number again.
144,256 kilograms delivered in one day off the Shanghai Gold Exchange. And so you're seeing outflows of metal, so much so that if you look at if you can pull up, if you do your editing or you're able to do that and pull up a graph of the outflow of silver from the London Metals Exchange, it's a straight line straight down. The same thing with the COMEX and gold. They're all being pulled down. Last year, not only that, the LBMA, the London Metals Exchange, lost 90% of its zinc and 75% of its aluminum. It's all being bought by countries that, to them, it's the same thing as money. So you are seeing the biggest money in the world use the suppression of price on the Western exchanges as cover to de-dollarize and accumulate what amounts to the lion's share of all the available gold, silver, platinum, aluminum, zinc, lithium, anything that they can buy. What did they just say? I think it was Brazil, who said they're nationalizing their lithium mines. The world realizes that we are moving, as Zoltan Pozsar said, into an era backed by commodities. He calls it Bretton Woods 3. Bretton Woods 1 is when the dollar took over for the pound sterling at the end of World War II in 1944. Bretton Woods 2 loosely would be classified as when we left the gold standard in 1971, closed the gold window, and now we're backed by the petrodollar. That's Bretton Woods 2. Bretton Woods 3 is a system, as Zoltan Pozsar calls, one backed by commodities and transparency rather than opaque debt instruments. And I think that's what is happening here. The world is accumulating tangible, real things for what comes next.
Okay, well, on that basis, why do you think, well, the majority of the gold market's fairly small, the silver market is pretty much the same. The price Yeah, I mean, if you look over 20 years, the price has done extremely well. But in terms of all this change in central banks, which is recent, buying up so much gold, and as you just said, silver, the price hasn't moved very much. Or do you think that's a lag effect and it's coming?
No, I think the markets are suppressed and manipulated 100%. They're
By whom?
suppressed by mostly the bullion banks, the commercial banks. And they, just to give you one more idea, and then I'll answer that question.
Yeah.
In the last 2 months, we've seen 230 million ounces of silver taken off of the London Metals Exchange in something called exchange for physical, where COMEX contracts are sent to London and the metal comes off. That 230 million ounces that was delivered in exchange for physical is almost 8 times more than is available for delivery off of COMEX. The country of India imported 304 million ounces of silver last year alone. And, you know, in the third quarter of 2022, 400 tons of gold were sent out of Western vaults eastward. That was reported by Reuters and Bloomberg, the largest single quarterly outflow ever. I mean, there are years where that much isn't delivered. The point of it is that the biggest money in the world for a very long time, JP Morgan, who paid a $920 million fine to the Justice Department for suppressing the metals, the bullion banks suppress the price, and they do so, in my opinion, to support the bond market here in the United States. Because for many years, we have had a zero interest rate policy. There's a term in economics called Gibson's paradox, which speaks to the inverse relationship between these two, real interest rates and the price of gold. Yeah, interest rates have risen, but what's the real return? It's still negative. That's why you're seeing so much interest in gold, even though rates are rising. The biggest money in the world is using the suppression of COMEX by the bullion banks who step on the paper price. Exactly what I'm saying to you. If there are 9,000 short contracts held by the commercial banks and only 6,000 contracts worth of bars backing it, that's not the way it's supposed to go. The market, the paper market, is not supposed to control or drive the physical market. That's the tail wagging the dog. It's the other way around. And so the big money suppresses the price of gold and silver to make the dollar and the US and the Western system seem better than it is. And it's been that way for a very long time. The way they used to do it, when nobody wanted anything but dollar-based assets, is they would lease their gold to the commercial banks, who would then sell it immediately to the market, drive the price down. They were leasing it at 0.5% from the central banks, like a bank like JP Morgan. They would lease gold, sell it to the market, leasing it at 0.5%. They would take the return. When you short something, you get money. You have to pay it back. You get money. They would buy treasuries earning 4%, let's say. They got to keep the spread between the two. The fact that the price was driven down, they could easily cover that short position and make a killing with immunity from the higher ups who told them to do that. Now, this was more or less admitted in court when there was a lawsuit that Blanchard, the precious metals company, brought against JP Morgan and American Barrick. And American Barrick said, well, you know, we moved for dismissal when this was brought up. This was in 2000, and I don't even remember what year, maybe 2001 or 2. And when it happened, the judge said, no, there's more to it than meets the eye. We're going to go to discovery. Well, the counsel for Barrick said, fine, you caught us, we did it. We suppressed the paper price. We forward sold into the market, but we did it at the behest of JP Morgan, who did it at the behest of the U.S. government. They have sovereign immunity by extension. We have sovereign immunity, and the case was sealed. But what you took from it was American Barrick agreed to close their hedge book and not forward sell anymore. This has been admitted. There's so much proof out there that the big bullion banks have been suppressing the paper price of gold and silver forever. Well, the rest of the world is using it against us right now by suppressing the paper price on COMEX. And to give you an idea of how they do it, the other day, it was a couple of months ago, I asked my head trader, because we hedge all of the gold in our warehouse. Yeah. If I have 5,000 ounces in my warehouse and the price drops by $100, I'm out $500,000. So with that 5,000 ounces in my warehouse, I sell 5,000 on COMEX. And they move exactly inverse of each other. So I'm always market neutral. And I said, Ryan, what does it cost for us to control one COMEX gold contract, which is 100 ounces? $200,000 worth of gold. He said $7,000 in our margin account. That's it. The trade is just a few dollars. So if I'm a commercial bank or a central bank with 500 million in my margin account, I can control effectively $15 billion worth of notional gold or silver. They suppress the price with tremendous leverage, and then the rest of the world gobbles it up when nobody is looking. I'll say it this way. If price was indicative of demand, then why is it that the exchanges, the LBMA, the COMEX, the Shanghai Gold Exchange, why are they seeing record outflows, record deliveries? And why are the central banks buying more gold than at any time in history over the last 18 months if price was indicative of value? Rather, it is misdirection. They are misdirecting with price and rhetoric, and they are de-dollarizing so much so that when they flip the switch, everyone else will wake up and say, what the hell just happened? I can't even find any. The price just went way up overnight on a Monday morning. I really believe there's way more truth in that than there is any type of supposition on my behalf.
So what you're saying there is it's been slowly, and then it'll be all at once.
Yes, and that's a common theme in this industry. You know, that's how what's his name, the author, went broke little by little and then all at once. And that happens here too. You could argue, if you look at the drawdown in supply off the COMEX, and you know, you're talking huge amounts that have been drawn down over the past couple of years, whereby, you know, you're talking, let's see if I can pull up the number to give you the exact number here. I might be able to, but that's been the little by little. It has been going little by little by little by little. And then I think, yes, we will wake up one day and it's gone. And I think that's why they've been doing it in a very methodical fashion. Right? Yeah. If you do it all at once, you cut off your nose to spite your face. If you do it very methodically in terms of how you drain the exchanges, it gives you more time to actually milk the cash out of the system. And I think that's what they've been doing. And I don't know if I can find the exact numbers here for you. I might be able to. Give me 10 seconds.
1, 2, 3, 4.
Let's see here. Well, here, since early 2021, COMEX silver inventories have fallen from 400 million to 271 million ounces. That's the entire COMEX. Of the 271 million, only 29 million are for sale. The rest of them belong to companies like me or hedge funds, or people aren't selling it. It's just in a COMEX warehouse. Over 28 months, that's 4.6 million ounces per month that have been leaving the COMEX in silver. That's just one exchange. You're seeing the same thing in the London Metals Exchange. You're seeing the same thing coming out of the ETFs. But when you pull out 130 million ounces of silver in 1,000-ounce bars, you've just lost all industrial liquidity. Where if Elon Musk says, I'll pay everyone who has 1,000-ounce bars on COMEX $100 an ounce premium if they sell it to me, you're done. You can't get it back on there and have it reassayed and reintroduced to the system without a very long period of time and a huge cost. When it leaves, it's a one-way ticket. It ain't ever coming back. So anyways, I just think that there's a lot more to it than meets the eye here right now in terms of the drawdown, the methodical drawdown of all the exchanges, because it's coming from very sophisticated people. It is not an easy thing to do. And when they do it, it's never coming back. And that to me is indicative of big money using price and rhetoric to misdirect their intentions of accumulating metals in place of dollars, place of fiat.
Andy, I want to get into a little bit of hopeism, if you like, for the folks that are watching this at the moment. I mean, you've said silver is probably the most misunderstood, I should say, asset on the planet, and woefully undervalued, potentially gold the same. We've had a wide-ranging conversation here, but what I want to just focus on now is, I guess, for the average man, lady, whatever on the street these days, what should they be doing and why should they be paying attention?
Getting out of debt, paying off variable rate debt, de-dollarizing the way the biggest money in the world is doing. It's just like the representative from the state of Idaho, who they're passing a law with about 8 or 9 other states in this country that are allowing gold and silver to be used as legal tender. And he stood up on the legislative floor and said, we need to let our constituents in the state of Idaho do what the central banks of the world is doing. And that is accumulating gold and silver to get out of the way of the monetary policy of the Federal Reserve and the fiscal policy of the U.S. government that's bankrupting this country and, by extension, our constituents. That's what you need to do. You need to pay yourself first, always. And if it's 1 ounce of silver a week or a month or 10 ounces or an ounce of gold a quarter, whatever it is, pay off your debt, get out of variable rate debt that will increase as rates rise, and prepare. And I think that's all you really can do right now if you're late to the party. I think that debt is going to be a very troublesome thing in a slowing economy, and one that comes with rising rates as well. That is what I would do. Pay yourself first, work, consolidate your debt, get out.
Andy, there's also good debt and bad debt. So in a rising inflationary economy, potentially hard assets would be okay. Now, I consider hard assets to be gold, silver, property, potentially art, potentially classic cars. Is that the sort of debt that's okay? But personal debt, car loans, depreciating assets, that's bad debt? Or are you saying get out of debt in its entirety?
Well, I mean, look, good debt I classify as a 3% mortgage in an environment where interest rates are double that, where the mortgages are double that. But that also comes with the caveat of your ability to service that debt or your ability to pay it off if things ever got really bad. I mean, I think that there's a lot to be said for letting the laws of compounding work for you instead of against you. And being out of debt is something that is very liberating. I don't think, most people believe that that's part of what you're supposed to do as you get older, go into debt. You get a car loan, you get a home loan, you have a loan to go to school, and you wake up one morning and you're, in debted servitude for life. And I think that, yes, there is such a thing as good debt, but that comes with a caveat, Yeah, do you have a 3% fixed mortgage in an environment where now there's 7% and you have a stable job and some savings? Sure, good debt. But again, I think one of the characteristics of this slowing economy, look, 70 major corporations in the retail sector here in this country have failed this year. What happens when your good paying job goes away? Can you still maintain your debt and service it? Now, there's some things you can't pay off, perhaps at this point in the cycle, but yes, I think you mitigate best you can any variable rate debt, like credit card debt, which rates are going to rise on those. As rates continue to rise, you'll see higher credit card rates, and any variable rate which will increase in that environment is something I would be very leery of. In general, pay yourself first, even if it means sending a little bit less to your creditors each month. Pay yourself first, or you'll never get ahead.
Yeah, pay yourself first in real money. Well, money is gold and silver. Everything else is credit. We all know that. And if you want to hear from Andy Schectman live and in person, he'll be speaking at the Rural Investment Symposium in Boca Raton, Florida. And that will be down the road from the debt ceiling being hit or not hit. It's definitely going to be hit. But whether they're going to raise it, what are they going to do? And I was there last year when Andy presented, and it was a fascinating presentation. And in fact, he won the best presentation at the conference. Spare his blushes there. Let's just finish up, Andy. If people want to follow your comments, what's your Twitter handle? And just a bit of a shout out about what Miles Franklin does.
We've been in business for 32 years as a precious metals company. We have worldwide exclusives in storage with BRICS around North America. Our website is milesfranklin.com. And good question. I use Twitter, but I am kind of old school. So let me tell you what my Twitter handle, I think it's A Schectman. I'm almost positive. That's really embarrassing, isn't it?
No, it's not embarrassing. You and I are of the same vintage. I'm the same. People say, what's your Twitter handle? I'm like,
well, I guess I have two. The one that I use most now is at Miles Franklin CO. I have a personal one, but I don't use that one very often. At Miles Franklin CO.
If you'd like to hear more from Andy on Twitter, make sure you follow him there. and come over to Florida. You might learn something. Andy Schectman, great to see you.
I've also done about 1,500 YouTubes over the past 3 years. So I do
That-
6 or 7 a week with people just like you every week. I'm all over the place out there.
Yeah, well, that's because you're trying to spread the word and get people to be awake. Andy, let's not leave it too long. Let's have a chat post the Rick Rule Symposium. But for now, thank you so much for joining me today.
You ask amazing questions. You're very sharp, and I like the pushback, and I appreciate it. And that's what a good conversation is about. I appreciate the opportunity to chat with someone as bright as you. And thanks for having me. I look forward to meeting you in person, seeing you in person rather again down the road.